Something strange happens the moment your portfolio crosses $250,000. It's not the number that changes, it's you. Most people think 250K is just another milestone, another line on a chart going up and to the right. But here's what nobody tells you. The moment you cross this threshold, the entire game changes. The way compound interest treats you, the way risk feels, the way one bad month can either barely dent you or completely wreck your progress. It all shifts, and if you don't understand these shifts, you can actually go backwards from here, even while doing everything right. This is Knox, and today we're breaking down exactly what happens after your portfolio hits $250,000. The psychological traps, the math that starts working differently, and the mistakes that quietly derail people right at this stage. Before we dive in, hit that like button and subscribe if you're serious about building real wealth. This channel is built for people who want the truth about money, not the fantasy. Let's get into it. Let's start with the number itself, because $250,000 is not random. It sits at a very specific point in the compounding curve, and understanding why it matters changes how you should think about every dollar from here forward. The compounding shift. Here's the part most people miss completely. In the early stages of investing, say your first $50,000 or $100,000, your contributions are doing almost all the heavy lifting. If you're investing $1,000 a month, that's $12,000 a year going in. Market growth on a small balance barely moves the needle compared to that. But once you cross $250,000, something flips. At a conservative 7% average annual return, that portfolio is now generating around $17,500 a year, without you adding a single dollar. That's more than many people's annual contributions combined. This is the point where the market starts outworking you. Your money is now doing more than your labor is. And that is an incredible feeling, but it's also where people get careless, because they assume the growth will just continue smoothly from here. It won't. Not in a straight line anyway. The volatility wake-up call. This is the part that catches almost everyone off guard. At $250,000, a normal, completely healthy 10% market correction is now a $25,000 swing. Read that again. $25,000. When your portfolio was $50,000, a 10% drop was $5,000. Uncomfortable? Sure, but manageable. At $250K, that same percentage drop now represents what took some people an entire year to save and invest, gone in a matter of weeks on paper. This is where the psychology of investing gets tested in a way it never has before. People who were perfectly calm investors at lower balances suddenly start checking their portfolio 5 times a day. They start second-guessing their allocation. Some panic sell right at the bottom, turning a temporary paper loss into a permanent, real one. The math didn't change. The market still behaves the same way it always has. What changed is the size of the number attached to your emotions. And if you don't prepare for that mentally before it happens, it will control your decisions when it does. The lifestyle creep trap. Here's something almost nobody talks about. Once people see that 6-figure balance with a 2 in front of it, something psychological shifts. It suddenly feels like I've made it. Even though $250,000, while a real accomplishment, is often still decades away from true financial independence for most people. This false sense of arrival is dangerous. It's exactly the point where people start loosening the habits that got them here. The nicer car, the bigger apartment, slightly less discipline on the monthly contributions, because the portfolio is doing the work now. But remember what we just covered. The market is only contributing around $17,500 a year at this stage, at a normal average return. If you cut your own contributions in half right when you hit this milestone, you can actually slow your total growth trajectory more than you'd expect. Right at the moment, compounding was starting to gain real momentum. The people who reach true financial independence aren't the ones who ease off at $250K. They're the ones who treat this as the moment to press harder, because they finally have real math working in their favor. The asset allocation reckoning. At smaller balances, your asset allocation mistakes don't cost you much in real dollar terms. A poorly diversified $20,000 portfolio being 10% too aggressive or too conservative is a rounding error. At $250,000, allocation mistakes become expensive. This is the point where many investors realize they've never actually sat down and calculated their true risk tolerance, their timeline to retirement, or whether their portfolio composition still matches their actual life goals. This is also usually the stage where people start hearing about more sophisticated strategies, real estate syndications, options income strategies, individual stock picking to accelerate growth. Some of these can be legitimate tools, but this is also exactly the stage where predatory financial products target people, because $250,000 is enough money to make someone feel like they need a more advanced strategy, and enough money to make a scammer or a bad advisor genuinely motivated to get their hands on it. The rule here is simple. If you don't fully understand a strategy well enough to explain it to a 12-year-old, that is not the moment to deploy a significant chunk of your $250,000 into it. The tax complexity jump. Here's a shift that surprises a lot of people. Once your portfolio crosses this threshold, especially if a meaningful portion is in taxable brokerage accounts, tax efficiency starts mattering in a completely different way than it did before. Dividend income, capital gains distributions, and rebalancing decisions all start to have real tax consequences at this size. A portfolio of $250,000 generating even a modest 2% in dividends is producing $5,000 of taxable income a year, every single year, whether you touch the account or not. This is the point where a lot of people should genuinely consider things like tax loss harvesting, asset location strategies, meaning what accounts you hold, which assets in, and whether you're maximizing tax advantage space before adding more to taxable accounts. These strategies barely matter at $10,000. At $250,000, they can meaningfully change your after-tax outcome year over year. The comparison trap intensifies. There's also a psychological shift that happens online specifically. Once you're at this stage, you start noticing other people posting about their 250K, 500K, or even seven-figure portfolios. And suddenly your very real accomplishment starts to feel small. Here's the truth. Reaching $250,000 in invested assets puts you ahead of the vast majority of adults in your country and globally. This is a genuinely significant milestone. But social media, and even some corners of the finance community, are heavily skewed towards showing extremes, either people just starting out or people who are already wealthy. The quiet, steady middle, which is where most real wealth building actually happens, gets far less attention. Comparing your $250,000 portfolio to someone else's $2 million portfolio without knowing their age, their income history, their starting point, or even whether their numbers are real, is a recipe for feeling behind when you are, statistically, doing extremely well. What actually separates people from here? So what determines whether someone at $250,000 ends up at $1 million or stalls out and never gets much further? Based on the patterns we consistently see, it comes down to a few specific things. First, consistency through volatility. The investors who keep contributing on schedule through market downturns, rather than pausing until things feel safer, are the ones who benefit most from buying at lower prices during those dips. Second, resisting lifestyle inflation. Every dollar of increased spending after a milestone is a dollar that isn't compounding for the next 20 years. Third, avoiding complexity for complexity's sake. Sticking with a well-diversified, low-cost strategy rather than chasing the next advanced tactic that promises faster results. And fourth, tax awareness. Making sure the strategy that got you to $250,000 is optimized to keep more of what you earn rather than losing unnecessary ground to avoidable taxes. None of these are exciting. None of them will make a viral headline, but they are exactly what separates the portfolios that plateau at $250,000 from the ones that quietly compound their way into seven figures over the following decade. So here's the truth about $250,000. It's not a finish line, it's a pressure test. It tests whether your emotions can handle bigger dollar swings without making irrational decisions. It tests whether success changes your habits for the worse, through lifestyle creep, or for the better, through renewed discipline. And it tests whether you're willing to keep doing the boring, unglamorous things, consistent contributions, sensible allocation, and tax awareness, even after the hard part feels like it's behind you. The people who treat this milestone as motivation to double down are the ones who look back in 10 years and see an account that's grown into something life-changing. The people who treat it as an arrival point are often the ones who look back and wonder where the momentum went. You made it to $250,000 through discipline. The next stage of this journey rewards that exact same discipline, just at a bigger scale, with bigger swings and bigger stakes. If this video gave you a clearer picture of what's ahead, hit that like button, subscribe for more breakdowns like this one, and drop a comment letting me know where your portfolio stands right now. I read every single one. This is Knox, and I'll see you in the next video.